Now, before we can even begin to talk about sustainable investments, let's chat about what the word investment actually means. An investment is an asset or item that is purchased with the hope that it will generate income or appreciate, referring to an increase at some point in the future. Ever watch the Property Brothers on television and wonder why they always talk about how flipping homes is an investment? That's because it is. It is an example of investing in an underpriced property and reselling it for profit. The traditional investment approach focuses on investing in companies or assets that project a strong financial report, considering factors such as earnings, profit margins, and debt levels. In other words, the traditional investment is going to reap the most bang for your buck and be highly profitable. However, if we add the word sustainable in there, now we're venturing beyond simply analyzing income statements and balance sheets. Sustainable investing looks at balancing positive financial outcomes with our three favorite letters, ESG, or the environment, social, and governance-related insights, to put forward long-term beneficial outcomes. Sustainable investments represent a forward-thinking approach that goes beyond probable financial gains by taking into account broader societal contributions that align with investor values. The biggest difference between traditional and sustainable investments: how we go about doing them. Sustainable investing requires investors to carefully assess the potential impacts of their investments in line with triple bottom line considerations, otherwise known as people, planet, and profit. This could look like investing in ethical funds to bolster local communities, supporting sustainable energy initiatives, or promoting local environmental conservation efforts. It could also mean selecting green investment companies or community-focused cooperatives. Whatever the investment may be, sustainable investing does not only involve thinking about financial returns, but thinking about how exactly this investment will generate profit. Fund managers play a crucial role in this process by evaluating companies based on their integration of ESG factors or socially responsible practices. When implementing an ESG approach, a proposed investment may undergo scrutiny for various factors. First are environmental considerations, such as a company's carbon footprint, waste management practices, and contributions to climate change mitigation. Secondly are social factors, including employee relations, diversity policies, labor practices, and community engagement. Third are governance standards, such as board transparency, tax policies, and measures to prevent corruption. Integrating these criteria into investment decisions enables individuals and institutions to contribute to a more sustainable and equitable future while pursuing financial returns. Additionally, while ESG factors are integral to sustainable investing, there are additional strategies that investors can employ. Activist investing involves buying equity in companies with the intent to influence operations based on moral values or causes. Impact investing targets investments aimed at addressing social or environmental challenges, including community investing and financing businesses with clear social or environmental purposes. In general, sustainable investing encourages companies to adopt sustainable principles, leading to long-term social and financial benefits. As more investors prioritize the alignment of their investments with their values, sustainable investing will only continue to gain significance and traction. Now, let's shift gears from talking about sustainable investment and dive into how exactly these principles are put into practice in the real world. Remember that sustainable finance isn't just a choice between helping the planet or making a profit. It's about achieving both simultaneously. As investors push forward with triple bottom line considerations, one commonly thought about factor is climate-related supervision and its increasingly stringent requirements. Why? Because climate change has far-reaching implications for businesses across all sectors. Rising global temperatures, extreme weather events, and shifting climate patterns are not only disrupting ecosystems, but also impacting economies, supply chains, and communities worldwide. This in turn means that companies must consider key aspects, including climate risk disclosure, principles for climate risk management, and mitigation measures, particularly for vulnerable populations. Climate risk disclosures are necessary to provide investors and stakeholders with transparent information about a company's exposure to climate-related risks and opportunities. Now, a risk does not only include the direct impact or consequences of climate change, such as environmental disasters, but associated or long-term consequences, such as community well-being and health. This transparency enables informed decision-making and helps investors assess the resilience of their portfolios in the face of climate change. In line with this, principles for climate risk management offer guidance on how companies can identify, assess, and mitigate these climate risks effectively. By implementing robust risk management practices, businesses can safeguard their assets, enhance operational resilience, and ensure long-term viability in our changing climate. Lastly, mitigation measures are essential, particularly for vulnerable populations, as climate change disproportionately affects marginalized communities. Low-income households, indigenous peoples, and coastal regions are often the most vulnerable to climate impacts, including extreme weather events, sea level rise, and food and health insecurity. By prioritizing mitigation efforts in these areas, companies can help build resilience and reduce immense social inequalities. Overall, addressing climate-related risks is a strategic necessity for businesses. The associated impacts presents an avenue for companies to seize more opportunities for innovative solutions making and adaptation. This means that the integration of finance expertise alongside with sustainability knowledge is now essential in today's job market, creating abundant opportunities within this sector. Today's growing sector calls for professionals with expertise not only in traditional finance, but also in sustainability. The skills and knowledge needed for these roles can take shape in many ways and require a diverse array of expertise to explore innovative strategies beyond tried and true pathways. For example, corporate sustainability roles involve overseeing a company's environmental impact, while sustainable finance consulting offers guidance on integrating ESG into investment strategies. ESG analysis aids investment banks in marketing sustainable and ethical funds, while sustainable finance leads to crafting financial strategies aligned with long-term objectives. Policymaking is also another essential skill, which plays a critical role in shaping sustainability standards across industries. These opportunities extend into diverse industries and diverse professions. In sectors such as agriculture, there's a growing need for professionals who can integrate sustainability practices into farming techniques, supply chain management, and agricultural policy. Corporate services encompass a wide range of functions, including human resources, legal, and administrative roles, all of which can benefit from expertise in sustainability to enhance corporate governance and social responsibility initiatives in agriculture. In design, sustainability-minded professionals are shaping the built environment by incorporating green building practices such as LEED certified standards, renewable energy solutions, and sustainable materials into architectural and urban planning projects. Energy companies are seeking individuals who can navigate the transition to clean energy sources, optimize energy efficiency, and develop innovative solutions for both renewable energy generation and storage. In the mining sector, sustainability professionals play a crucial role in ensuring responsible extraction practices, minimizing environmental impacts, and promoting community engagement and development so investors know what exactly their investment is getting into. Similarly, in manufacturing, there's a growing demand for experts who can implement sustainable production methods, reduce waste, and improve supply chain transparency and ethics for long-term beneficial investments. Public administration agencies at all levels of government are of course integrating sustainability principles into policymaking, regulatory enforcement, and public services. Professionals in this field help with investments by developing and implementing initiatives that combat climate change, promote environmental conservation, and advance societal equity and inclusion for the long-term goal. Within sustainable finance itself, the range of roles is expanding beyond traditional finance positions. While accountants and auditors play a vital role in ensuring financial transparency and compliance with sustainability standards, other professionals are also essential. Business operations specialists focus on optimizing processes and systems to align with sustainability goals, while compliance officers ensure adherence to regulations and ethical standards. Last but not least, cost estimators assess the financial implications of sustainability initiatives by helping companies make informed decisions about resource allocation and investment priorities. They play a role in each of the previously discussed sectors. As financial institutions recognize the importance of sustainability in investment decisions and are now not only increasingly hiring cost estimators, but ESG specialist portfolio managers and consultants. These professionals assess environmental, social, and governance factors to guide investments toward companies that align with sustainability goals and contribute to the transition to a net zero emissions economy. All in all, as sustainability gains traction across industries, careers in sustainable finance offer diverse paths for individuals seeking to create positive change while also advancing their professional journey in sustainability. As we continue to navigate the complexities of sustainable finance and climate-related risks, it is clear that the choices we make today will shape the future of our planet, people, and profit. By integrating sustainability into our financial practices, we not only mitigate risks, but unlock new opportunities for innovation, growth, and positive societal impact. Whether you're an investor, business leader, or policymaker, embracing sustainability is not just a moral imperative, but a strategic imperative for long-term success. Together, we can all work towards building a more resilient, equitable, and sustainable world for generations to come by exploring opportunities in sustainable investment. Thank you for joining us on this journey, and until next time, stay tuned for more insights on navigating the intersection between finance and sustainability in today's world.